Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. It's the 18th of January 2024 and here are the questions we will be answering today. Will the Binance crackdown offer a fillip to Indian crypto exchanges? Why are Indian hills facing a snowless winter? Will the rally in PSU stocks run out of steam? And what is the Bitcoin Spot ETF? India blocked access to 9 foreign crypto exchanges on the 12th of January. The government believes that these offshore platforms were not complying with the country's anti-money laundering law, and that investors were also using them to circumvent tedious costs. Some of them, like Binance, were quite popular among domestic investors. Now, crypto investors are reportedly flocking to domestic exchanges. There is a surge in registration. So will this crackdown on offshore exchanges help domestic crypto platforms? Kasturi Akhil finds out.
A thaw in the prolonged crypto winter is on the horizon. Domestic cryptocurrency platforms are seeing a notable surge in daily transactions and user registrations in deposits following the government's recent crackdown on offshore platforms in late December. The cryptocurrency market cooled off in 2022 when the Indian government imposed tax on digital assets. The government introduced a 30% tax on crypto gains and a 1% tax deducted at source on crypto transactions. The Ministry of Finance had issued show-cause notices to 9 foreign cryptocurrency exchanges for non-compliance with the anti-money laundering legislation. These included big-ticket virtual digital asset platforms like Binance and KuCoin. The result? Volumes are growing again. This sudden bullishness in the domestic crypto market allowed platforms like WazirX and CoinDCX to see a 2,000% increase in deposits over 2 weeks. Back in 2022, the new taxation regime reportedly drove a large number of Indian traders to offshore exchanges. A report by think tank Asia Center revealed domestic exchanges lost trading volumes worth around $3.8 billion to offshore bosses after the government introduced tax on virtual assets in Budget 2022. But those crypto investors are now flocking back to domestic exchanges. WazirX and Mudrex estimated that roughly 70% of their fresh inflow came from Binance, which is one of the world's largest crypto exchanges. CoinDCX's fresh inflow from Binance was estimated at around 40%. Industry insiders say the crackdown on offshore crypto platforms has effectively leveled the playing field for domestic crypto exchanges.
I think this is a step in the right direction. What is going to happen is that foreign exchanges were making use of regulatory and taxation arbitrage, which means that Indian exchanges who were following the law of the land were being unduly punished for being, legal, for doing everything that is legal. So this is the step in the first direction, in the right direction. What they are saying is that you will have to actually follow Indian tax rules if you're servicing Indians, no matter where you are operating out of. So this is the first step. The second step would be actually to ensure that those exchanges also actually pay the TDS that the government has actually mandated for all crypto transactions.
Business Standard had earlier reported that domestic crypto exchanges are exploring strategies to attract investors who have migrated to offshore crypto platforms. But the endeavor seems needless now. Apple has removed apps of the 9 foreign crypto exchanges from its App Store in India after they were flagged illegal in the country. Several offshore crypto apps were also removed from the Google Play Store on 14th of January this month. But is this bullishness in the Indian crypto market only a brief relief or more long-term gain awaits?
In short term, yes, there is a very good inflow, but I seriously feel that we as Indian exchanges, though we should be happy about this that is happening, we should still be working towards how to get users through our products and service, not by this way. We don't want to have a scenario where the users are coming to the platform because they're forcefully coming back, right? I mean, so I'm not going to say I'm not really happy, but yeah, we are happy that the users acquisition is growing, the volumes are growing. But we also understand the fact that this is not something that is good for the long-term growth of any platform.
The RBI has long maintained a cautious stance on cryptos. Later taxation of the asset class pushed Indian crypto exchanges to diversify their offerings to increase user participation. CoinDCX introduced a DeFi wallet called Octo. A DeFi wallet is a decentralized, non-custodial virtual wallet that stores one's crypto assets. And CoinSwitch is in talks with the regulator to launch a wealth tech platform offering asset classes like fixed deposits, stocks, and mutual funds. So, is diversification within and outside the crypto ecosystem essential for long-term growth? Vikram Subbaraj of crypto platform Kiotus believes expanding beyond the crypto ecosystem may not ensure sustained growth of the platforms and customers.
There is still a lot of exploration that has to be done in the crypto ecosystem and that has to be offered to the customer. There's so much of opportunities left here, right? Now, leaving this and jumping into another ecosystem, which is even complex. Equity is not an easy ecosystem. It has got a lot of regulatory intervention. It has got a lot of competition that is there. Now, putting your legs in two ecosystem, which has got a lot of regulatory and competition, it is just a mixture trying to kill yourself in the longer run.
Indian crypto players have reiterated their expectations of slashing tax rates on crypto assets in the upcoming union budget. Rajagopal Menon of WazirX suggests that such a measure would help sustain the current uptick in crypto users on Indian platforms. For now, it appears that the crackdown on the likes of Binance has provided a short-term but much-needed relief to domestic players.
Clearly, there are signs of a thaw in the crypto winter, which started with the collapse of the famous foreign exchange FTX. But for many, winter means a season of earnings. The longer it is, the better. But even as North India is reeling under a prolonged spell of winter, its famous skiing resorts are without snow. Locals in Uttarakhand's Oli and Kashmir's Gulmarg, whose livelihood depends on tourists, are looking towards the sky for some divine help as tourists are cancelling their bookings. But why are these hills having a snowless winter? Ayush Mishra looks for the answers.
This is the time of the year when the higher foothills of Himalayas are loaded with snow. This white sheet of ice not just feeds rivers, but also thousands of locals in hill states of Uttarakhand, Himachal Pradesh and Kashmir. Several small towns of these states are now pinned on the global tourism map, thanks to their classic postcard views. And some of them have also turned into skiing destinations like Gulmarg in Kashmir, Solang Valley in Himachal Pradesh and Oli in Uttarakhand. But a key ingredient which turns these hill stations white and picturesque during winter is missing this time, and so are the tourists. Most hills in Gulmarg, Solang Valley and Oli were without snow till the mid of January. Experts believe this is happening due to the lack of robust western disturbances. But what are western disturbances? The main source of winter rain and snow in North Indian hills is extratropical storms, which brew over the Mediterranean region. These disturbances are known as western disturbances. It is a non-monsoonal precipitation pattern which travels westward to northern Bangladesh and Nepal. So when hills got scanty rains and snow, experts blamed it on the lack of substantial western disturbances. The meteorological department recently said that Himachal Pradesh is undergoing the driest January in the last 2 decades. all due to this weak western disturbance, and experts blame it on global warming.
For Indian conditions, for hill stations, western disturbances, they play pivotal role in bringing a good amount of snowfall and rainfall. And disturbances, or that shift in the western disturbances, that are responsible for bringing good amount of snowfall and rainfall in the winter period in Kashmir and in Himachal Pradesh, are the major reasons why our hill station, they are snowless this time, at this particular time period. So, and another factor is El Nino. Again, that is a global environmental disturbance caused due to the uneven heating of the water in the Pacific Ocean, which is resulting into dry spell or lack of snowfall and rainfall in particular regions in India.
Visuals of snowless mountains, which were shared widely on social media platforms and on TV news, led to a sharp dip in tourist footfalls. Gulmarg reported a massive 70% drop in visitors. The hospitality and adventure sports sectors are severely affected, with cancelled hotel bookings and disrupted winter sports activities. The upcoming Khelo India Winter Games in Gulmarg are also staring at a dry landscape, unlike the snowy backdrop in previous editions. The tourism sector in Jammu and Kashmir generates approximately 8,000 crore rupees annually, constituting nearly 7% of the state's GDP. It employs around 70,000 people directly and indirectly. In Himachal Pradesh, the tourism industry generates 11,000 crore rupees, accounting for 7.3% of the state's GDP. So if we continue to experience snowless winters, how will this impact tourism in the hills, especially during winter months?
People expected good amount of snowfall, they expected cool temperatures, something what we call as a really cool winter period, or proper winter period there, but it just didn't happen. And so for some people who wanted to go there, let's say in mid-January or yesterday, so they would have expected what we call as a really cold period there in Jammu and Kashmir, for example, or in Kashmir Valley. But temperatures there were significantly above normal by something like 5 degrees or 10 degrees above normal. So it's quite disappointing thing for tourists, number one. And then that also affects local people, because tourism is one of the important source of livelihood for local people. So if tourists stop coming to Jammu and Kashmir, Himachal Pradesh and Uttarakhand, let's say in the remaining part of January or February, then that is also going to have significant economic impacts.
Based on what the seasons are, people go there for spring, people go for summer, people go for winter, people go for snow. Now, it's like if there are certain people who like the snow, and if there is no snow, they won't travel. But that does not mean that the tourism impact will be year-round in this region. Like Gulmarg also has summer tourism, so which is going to continue. Gulmarg also has spring tourism, which is going to continue. As I said, I mean, it's and snowfall in India is primarily in the January-February period. And that's the time there will be an impact. Now, as I said, there is no data which is available to, or rather, I don't have access to the data to say that what is going to be the impact. But we can see the numbers are dropping, and definitely Jan-February numbers will drop. But that does not mean that the overall tourism for the year is going to drop.
Clearly, weather has played spoilsport with tourism in the hills of North India. But experts hope that it may be a once-in-a-while occurrence which we may not see in the next winter. However, tackling global warming is crucial, as it will have wider ramifications.
From hills, let us move on to financial markets. The government's Make in India push and indigenization in the defense space opened the floodgates for order flows for most PSUs in 2023. Nearly 30% of the stocks doubled investors' wealth last year, while 27% stocks hit record highs. The rally has extended thus far in 2024, with the Nifty PSE index touching an all-time high on January 16th. The rally has taken valuation multiples to multi-year highs. So will the pack be able to defend its gains, or is a sharp correction around the corner? Nikita Vasisht finds out.
The benchmark BSE Sensex and Nifty 50 dropped over 2% each on January 17 as a rout in global markets coupled with bear hammering of HDFC Bank stock left investors looking for cover. Yet, the pocket that managed to outperform the frontline indices were shares of public sector undertakings, where the index ended less than 1% lower. Shares of public sector enterprises sold like hotcakes on the bourses in 2023. Such was the fervor that 1 out of every 3 PSU stocks doubled investors' wealth last year. Among the lot shares of REC, Power Finance Corporation and BHEL returned up to 254% on the bourses in 2023, as against a 20% rally in the Nifty 50 index. The Nifty PSE index, meanwhile, advanced 80%, and the rally has, extended into 2024. The Nifty PSE index hit a lifetime high of 8,264 on January 16 as optimism around the return of the ruling Bharatiya Janata Party at centre later this year gained strength. This, analysts said, bodes well for the government-driven capex cycle in the sector.
If you look at the order books of players in the railways, shipbuilding or defense space, it is sitting at an all-time high order book. And it makes sense why the share price is also performing really well. Now, when it comes to the exuberance side, the market is currently expecting that the current government would come into power once again and announce the same sort of aggressive capex that we've seen in the last 7 to 8 years.
According to data by Comptroller and Auditor General of India, Centre spent 58.5% of its 10 trillion rupees capex target for FY24 between April and November. Going ahead, analysts at Antique Broking expect a low-teen government-led capex push to continue over the medium term. It remains overweight on defense equipment manufacturers, railways and consumables, and sees strong order inflow of 21% and order book flow of 17% CAGR over FY23-26, as against 4 to 5% CAGR over FY13 to FY21. This, it said, may result in FY23-26 EBITDA CAGR of close to 26% as against minus 3% CAGR over FY13, FY21. So, is there more steam left in the pack?
Lot of these PSU stocks are trading at their highest points in the last 5 or 10 years. So we believe that a lot of these PSU stocks are currently trading at rich valuation multiples. Obviously, the rally is because a lot of these stocks are getting or are having good order books. But this leaves very limited room of the margin of safety.
Thus, while valuations make PSU stocks susceptible to profit booking in near term, analysts say investors remain watchful of capex outlook and political developments in 2024 before investing in the pack from a medium-term perspective. On January 18, global trends and Q3 results back home will guide the markets.
He's making plans for an early retirement. Business Standard.
After stocks, let us look at what is happening in the world of cryptocurrencies. The US Securities and Exchange Commission last week approved applications for exchange-traded funds, or ETF, that are primarily based on Bitcoin. Supporters hope that it will attract new investors to the token and boost its price in the long term. Now, what is the Bitcoin Spot ETF? Find out in our Decoded segment.
Bitcoin excitement has hit Wall Street. Its value touched $47,000 as the US securities regulator approved the listing and trading of a number of spot Bitcoin ETFs. It's the first time Bitcoin crossed the $47,000 mark since April 2022. A spot Bitcoin exchange traded fund is a financial product that allows investors exposure to this cryptocurrency through the traditional stock market. Unlike futures-based Bitcoin ETFs, which derive their value from futures contracts, Spot Bitcoin ETFs hold actual Bitcoins. A spot Bitcoin ETF operates by purchasing and holding actual Bitcoin on behalf of the investors. Here, an investor essentially buys shares of a fund that owns a corresponding amount of Bitcoin. This enables investors to participate in the potential gains or losses of the cryptocurrency market without having to directly buy, store, or manage digital currency themselves. The ETF structure simplifies the process for investors who may find dealing with cryptocurrency exchanges and wallets complex or risky. It provides a regulated and familiar investment vehicle through stock exchanges. Investors can buy and sell shares of the ETF on the stock market just like they would with any other traditional stock. Spot Bitcoin ETFs are subject to regulatory approvals and are designed to track the spot price of Bitcoin. Spot price refers to the current value of Bitcoin at any given moment without considering future contracts or derivatives. This direct link to the actual cryptocurrency's value distinguishes spot Bitcoin ETFs from other types of ETFs. While spot Bitcoin ETFs offer a straightforward way for traditional investors to access the cryptocurrency markets, they also come with risks. Price of the digital asset can be highly volatile, and the value of the ETF shares will fluctuate accordingly. Additionally, regulatory approval and market acceptance are crucial for the success of spot Bitcoin ETFs, as they are subjected to the regulations of the jurisdictions in which they operate. To invest in Bitcoin ETFs traded in US exchanges from India, one has to open a demat account with foreign brokers or brokers who deal in US stocks. It's similar to trading in shares in the US stock market. The US securities regulators' approval of ETFs to track Bitcoin is seen as a landmark move that will push cryptocurrencies into the mainstream. Crypto enthusiasts hope the 11 new funds backed by asset managers such as BlackRock and Fidelity Investments will draw more investors to Bitcoin.
The nation's trusted bank, SBI, the banker to every Indian.
But investors are still cautious as the ETF pulled in under $1 billion in the first 2 days of trading. Well, that's all for today. For more news and analysis, please log into our website, business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.